better. Something about the cloud.
Yeah, there we go. All right, so I will get everyone admitted. I'm sure there'll be some trickles in, so I'll Ryan, I'll let people in as they come into the old waiting.
Perfect.
Just do the screen then.
And I will mute whoever I need to mute. Go. What do you say we give it another minute and then get rocking and rolling?
Perfect. Market's still up, so that's good. Always good to do these with a little green on screen. Just, always feels a little better. I don't like doing it when the market's down 2.5%. Don't like going on TV when the market's down 2.5%. It's nice.
Even when it's bouncing around like the last couple of weeks, it's
right.
It's hard. I mean, I always call these crystal ball conversations, but I at least like having a crystal ball that has some data behind it, which tends to help. So yeah, I'll take green. Green will be nice after the last couple of years of some.
Exactly.
What color do you get when you mix red and green? Just brown? Because that's probably an accurate description of how much.
Yeah, that's kind of that's what it's been the last year. Kind of just brown.
Yeah. In a politically correct way, yes. That I would say that's probably the best way. But all right. Well, why don't we get started? And then as people come in, like I said, I'm recording this, and I'll get video sent over to everyone that wasn't able to make it or perhaps wants to rewatch. But so thank you everyone for coming. Today is I think going to be very educational for everyone involved. Ryan is a great resource. I'll let him introduce himself a little bit. I don't have a bio in front of me, unfortunately. I know your list is a little too long for me to memorize, but in terms of our goals for today, our goal is really to educate you guys on where we think, at least to the best of our knowledge, things may be going in the next quarter or next year. And a lot of that's based on how past markets have taught us to look at these things. So Ryan, if you want to kind of take it away, by the way, at the end, we will open it up to questions. We'll have another, call it 25, 30 minutes for questions. And if there is anyone that has a question they want to ask off air, whatever you want to call it, off the Zoom, just give me a call or shoot me an email. We can always chat. But without further ado, Mr. Ryan Detrick, thanks for joining us today.
All right, good. I guess let's see. Is it good morning still? Is it morning in Phoenix? What is it? Good lunchtime? What time is it?
Yeah, it's 11 a.m. but 90. So I'll let you make of that.
Okay.
Yeah, I would say brunch time.
Call that whatever you want. Yeah, good morning, good evening, good afternoon, wherever we are. I'm on the East Coast here, but I'm really excited to be here. Thank you, Jake, for inviting me. Yeah, I rarely eat breakfast. I'm kind of trying to just stick with 2 meals a day, and I've got a sixth grader, and he's like at the end of the school year. I'm sure some people on this call have kids at the end of the school year, and he and his buddy said whatever. So we let him go into school late. They hate music class. Don't judge me. Blame his mom. So we let him go in late today to miss music class. I thought it was the greatest thing ever. So I had a nice breakfast. So I'm kind of almost getting hungry now. It's almost lunchtime, but I had a big breakfast is more than normal. So anyway, we can talk about food all day, but there's a lot of stuff to talk about. We're going to talk about the outlook here. 2023 outlook. We wrote this at Carson Group a couple months ago. This is an update, right? What are we seeing? At the end of the day, Jake, like you said, I'm going to talk a lot about the economy, a lot about your investments, stocks and bonds, what the Fed is up to. I'll make it easy to understand what the Fed is up to, what's going on with inflation, all the things you hear about on TV. And if you see me look to the right, it's because that's where my TV is. I get little glances. I mean, hey, we're bouncing today, right? I had a red day yesterday, bouncing today, so that's nice. But there's a lot of stuff I want to talk about. I'll go 30, 35 minutes, maybe a little longer. Sometimes I get long-winded, but we will leave time for, I'll stay here as long as you need me for some Q&A. So there we are there. Look at those two guys looking good there.
That's back when I had hair, by the way.
There we go. Yeah, I mean, it was funny in my previous job when I did these, I'd use one from like 7 years ago, and I'd make a joke about how, that's what you look like before a pandemic, before a terrible bear market with, I got more gray hairs, maybe less hair, that's
before a child. And now,
well, that's true too. That's a good point.
So
yeah, I've got a 15-year-old daughter, a 12-year-old son, and a 10-year-old son. So we always have someone in a state of chaos crying in the corner. Usually it's my wife or I, but no, it's a lot of fun. Yeah. So yeah, let's start with a little teaser. You know, let's make it fun. What do you call a small biologist? Maybe you've heard this or not. A microbiologist. Dun, dun, dun. Yeah, that's sorry. We'll get into it now. There's so many ways we can go with this conversation, but I love to look at the past, kind of like you hinted there, Jake, to show, you know, we've been through some really, really rough times before. We've gotten through them, right? The Dow Jones Industrial Average, actually, its birthday's coming up. May 26, 1896 is when the Dow started trading. The S&P 500, as we know, it was 1957, but the Dow's the big one, right? And here's the truth, guys. Every single time since 1896, the Dow's eventually gone back to make new all-time highs. Now, we're not allowed to make guarantees on this, but I will say I'm fairly comfortable saying we'll make another new all-time high in the Dow eventually. Dow's like 7 or 8% away from all-time high. Dow's underperformed this year a little bit, but, you know, wars, famines, just terrible pandemics, 200-year pandemics in there. Terrible things have happened, but stocks have come back every time. Now, sometimes it takes longer, sometimes it's quicker, but we're going to lay out why at the Carson Investor Research Team, we came into this year thinking stocks would do pretty well. And you look at the S&P's up like 8% for the year as we speak. Now, yes, technology's up a lot more. It got beat up last year. And some of the energy, which did great the last 2 years, is given some back. That's how this works, right? You're always going to have some give and take. But overall, you know, I mean, most of you probably didn't like your stock portfolios that you had last year. That wasn't Jake's fault. It wasn't my fault. It was, I hate, you know, like making excuses. It's just a rough year. We'll get into it. A bear market last year for stocks for all the different reasons we'll talk about. But there are some real good things that are happening. Now, here's one way. Mark Twain. I love Mark Twain quotes. I don't know if he really said it, but I'll give him credit for it. He said, history doesn't repeat itself, but it often rhymes. I love to use that. And here was just a simple thing. We had a really good start to the year. Again, it's like our update, right? The update to what we wrote in our Outlook 4 or 5 months ago. When you have a 5% gain in the first quarter, like we just did, we had more than that, actually 6%, 7% gain, sorry, in the first quarter, on the heels of a 7% gain in the fourth quarter last year, by the way. It is what it is. You see it there, the final 3 quarters. So call that the rest of the year. Up almost 10% of the time, you know, higher 94% of the time. So again, it's just one data piece, yes. But when you kind of start laying some of these on, there are some reasons with an economy that continues to surprise to the upside, a Fed that likely is done hiking, inflation that's coming back more than most people thought. I'll get into all those. That's the big headline stuff, though. A consumer that's still strong. I mean, just yesterday, we had industrial production numbers that came in better than expected. Retail sales were quite solid. They were a little weak if you look at the headline because gas stations didn't do quite as well because, you know, gas was lower. So the consumer still looks really healthy. And if the Fed is done hiking like we think they are because inflation's coming back, these are all positives. We are fully aware of all the negatives. The economy has slowed down, right? Last year, you had a recession in manufacturing. You could argue, depression in housing. What are we seeing now, though? We're starting to see those things, which are headwinds last year, are becoming tailwinds. Last year at this time, what were we talking about? Supply chains, right? Remember those big ships all out in the Port of California, Port of LA? They were stuck there, cost all tons of money to ship things. Supply chains are like back to normal. We had data yesterday that we created, the cars on the production line were up 9% month over month, automobiles on a production line. What's that mean? That's one of the biggest monthly jumps ever, all right? Supply chains are coming back. You might be making cars if you didn't think you could sell them. Okay. So I just don't think that we're headed into this massive recession that you're going to keep hearing about on TV, or you do keep hearing about on TV. And these are some of the things I definitely want to point out. But all in all, you know, it's been a nice start to the year. So here,
if I can add to that really quick.
Go ahead.
I think it's a testament to how strong the data appears to be that in an industry where we can never say always and never say never, we feel as confident as we are with where we think things are going. I mean, you look at, and correct me if I'm wrong, but typically with recessionary times, it's not actually reported by economists until 3 to 6 months after the market has already hit its lowest part from trough.
Right.
So from that point as well, you know, I think it's another or further testament to confidence in markets with how we've had the last couple of months.
Amen there. The truth again is we hear it's an official recession by the time maybe you're getting out of it. It's kind of the honest truth. Now there's a lot going on here. I won't get too in the weeds on this. We do something called the Carson House Fuse for our advisors. And we run money, right? We run a lot of money for our advisors as well. And the bottom line is we like stocks over bonds still. And you look at this, we like small caps also. We'll get into some of these things, but if you don't think a recession is coming, we think, areas like small caps and mid caps, which have struggled, they have struggled lately, for the rest of this year could really be a place that there could be some opportunity. That's how we're positioning things. International equities, we actually did just upgrade those from underweight to even weight. Think Europe. Guys, as we sit here and speak, France is like an all-time high. German stock market's all-time high. Japan, the Nikkei just closed above 30,000 for the first time since September. One of the unique things that we're seeing, the U.S. led for like the last decade, stock market-wise. Now, the U.S. is doing okay, but we're seeing leadership from other parts of the globe, specifically developed international. We don't like emerging markets as much. Think of China and some of those things. We're not so sure about those areas, but we really look at developed international, and you see some of these areas doing well. This time a year ago, what was one thing everybody agreed on? I mean, everybody, probably me too, to be honest. Europe are going to a recession. Europe are going to a recession. And then what happened, we had one of the warmest winters ever. Mother Nature kind of came in and almost saved the day with all the heating and all the different prices because of the terrible war that's taking place. Bottom line, European data is really improving. Europe's not in recession. They're starting to rev away. They might have been in one last year. They're not in one now. And 3 to 6 months out, it sure doesn't look like Europe is going to be in a recession. So those are some positive things from a global point of view.
Yeah.
I like to call this like the slingshot idea. As everyone on this call unfortunately knows, last year, what happened? Well, the terrible war happened. We had the most aggressive Fed schedule of hiking rates we've seen since the early 1980s, major supply chain issues, China, startup, lockdown, startup, COVID case, lockdown, back and forth. All of those things were a terrible time for stocks. Stocks had a really, really rough year. We know that. But bonds, right? Bonds usually zig when stocks zag. I don't know how they do this, but Ned Davis Research, a group that I'm a fan of, they said it was the worst year for bonds since George Washington was the president. It was a really bad year for that diversification that bonds tend to provide you. Good news again, this year, bonds have come back. Stocks have really come back. So that's good. That was last year. But again, the idea of a slingshot, and this is another example of it. You can see when the previous year is down, so check mark that for last year. When you have a big jump in January, kind of what I call like a slingshot effect and up 5%, or you can see quite a small sample size, but check out those full year returns. Now, again, we came into this year, and I might have a slide on it coming up, saying the S&P gained between 12 to 15%, which is a pretty good year. But you look at this, that's like half of that. I mean, believe me, I hope I'm wrong. I hope we gain a lot more than 15, to be honest. But we're one of the more optimistic shops. The S&P is up like 8% as we speak right now. So we're like halfway there. But again, just the idea that we had this slingshot. Look at some of those years. If those years ring a bell, those are, again, after rough situations, but then definitely did a lot better. Now, is it always simple? Is it always easy? I don't think it's always as easy as people think. Now who, you know this guy, Jake?
No, I'm not familiar.
Yeah, well,
I do think that there seems to be bad juju with acronyms that start with S. So
yeah, so there's Sam Bankman-Fried. You've probably heard some of that, the stuff. He was the crypto guy. They got himself in a lot of trouble, pretty much having a scam of a company, to be honest. And the truth is, look at this. Fortune magazine, the next Warren Buffett. Maybe not. Probably not is the way to put it. So this isn't always easy. You know, my job's a lot of fun, though. And again, I'm honored to get to spend a little time with everyone on this call today. I'm a market strategist. I get to go on TV. I was on TV yesterday, radio today, get to write commentary, get to travel the country, present, talk about things, but work on a really, really smart research team, creating what I like to think is unique data pieces and data points that tell a story to help you understand things. I love the story of the Mona Lisa. I'm going to paraphrase it. I might get some of the years wrong, so don't judge me too much. But the Mona Lisa was maybe a top 50 famous painting ever, right? In the late 1800s or so. It was stolen. It was stolen right out of the Louvre. Like a custodian took it under his jacket and walked out with it, apparently. Then it was gone, all right? Then it shows up on the black market. France paid an incredible amount of money for it. Don't know how much, you can look it up, but a lot of money for it. So we want it back. So they bought it. Now it had a story. Now the Mona Lisa is the most famous, what's the Mona Lisa worth? Gee whiz, who knows, but now it had a story behind it. I love that example. And again, if we can tell stories, it's going to help you understand what's going on, but also help you remember these things. Those are kind of the ways that I'm a little different than maybe your average market strategist. And I like to weave stories and history to tell what potentially is happening and what might happen. Now, here's what we feel fairly confident is happening. most investors do not feel very good about things. And we get it, right? The super high inflation, the bear market, the economy that didn't go into a recession in our view, but parts of it did. You know, if you're in the real estate industry over the last year, things weren't as good, coming back a little bit. Manufacturing's been weak, obviously. This is just a sentiment poll. You can see the most hated thing at the bottom, U.S. equities. All right. people don't like U.S. equities. Now, from a contrarian point of view, what I've learned in studying market history, Churchill said, if everybody's thinking alike, somebody isn't thinking. That's another good one. And it's just so obvious this time 6 months ago that the market only had one way to go. That was down, the market being the stock market. And we came out and said, no, we didn't agree with that. We upgraded our view in equities the last week of December last year, added some equity risk to the models. We got some side eyes and some weird looks when we did it. And a lot of it was because there's so much negativity was priced in. Maybe you have a mild recession, but like a big recession was being priced in. Any good news could spark what we're seeing this year. You know, I mean, the NASDAQ's up like, I think close to 20%. The NASDAQ 100, your largest 100 companies, up well over 20% this year. Now, trust me, energy's down 10%. Other, industrials are about flat. But when you kind of look at the market in a whole, yeah, there's been some pretty good opportunities this year. And we still see it. There's a Gallup poll that just came out the other day. And they asked like stocks, bonds, gold, real estate. I think those are the big ones. They asked a couple thousand people, what do you think will be the best investment long-term? Well, stocks came in the lowest they've come in since 2011. And again, that's kind of music to my ears because we're going to talk about the economy and the Fed and those things, which we think are still positive. But that lowered expectations when nobody wants to touch it, that tends to be one of the times you want to invest again, as everybody's thinking alike, somebody isn't thinking. We've seen a lot of historical bearishness. So what do you think there, Jake? I mean, you hearing that from your clients? I mean, the concern that's out there?
Absolutely. Yeah. I mean, I think there's two components to that I could add. And the first is that Michael Burry, for those of us that have seen The Big Short, right? Famously played by Christian Bale, blaring heavy metal music, no shoes.
Yep.
Very successfully navigated the 2007 to 2009 financial crisis, right? But there's now an old joke that talks about how bears will always be bearish. And it's that Michael Burry has successfully predicted 100 of the last 2 recessions. If you're always a bear, you're always a bear. And you make a market in that. There's a number of people that go on the TV and they're go on the news and they make a living being bearish, and it scares people. The second thing I could add to that, and I beat this like a dead horse, is that I like to look at this as Black Friday. When people often find deals on Black Friday, they're very quick. Previously, you get trampled on running into a Walmart to get a TV for 40% off. But when the market presents opportunities to buy those same, devices, or the companies rather that manufacture them, we run for the hills. It's just very counterintuitive. So rather than running towards a sale in an asset class that would allow us to grow with the markets or the economy, I shouldn't say I think consumers tend to run and hide when the time should call for the opposite, which Warren Buffett's always been pretty good about preaching.
I love it. There's another saying, the stock market's the only place where things go on sale, but everyone runs out of the store screaming. And that's the truth. You might say, this is not a recommendation. You might say, you know what, Facebook, if it were to drop 10, 15%, I might want to add a little bit, just for whatever reason. And again, not a recommendation. But then it happens. And what do? You freeze, you panic. You said, but on TV, they said there's a debt ceiling issue, which we'll talk about in a second. There's this, there's that. And that's why, all of you are really lucky to be on this call, right, with Jake and the leadership that he shows, and hopefully the partnership that I know he shows. Eisenhower said let me make sure I say it correctly. Plans are useless, but planning is everything. I love that one. And again, you might plan on doing something, then you're, it's the old Mike Tyson quote. Everyone's got a plan until you're punched in the face, but it's true. That's why it's so important to make these plans and really stick with them, because our brains are wonderful, wonderful things. But when there's a bunch of red on the screen and terrible things are happening, our brains short fuse and they don't work the way they're supposed to. It's not our fault. It's how we are wired. But that's why you work with Jake and smart people to kind of make sure you don't make a poor decision at the absolute worst time. Because unfortunately, and I've done it, believe me, a ton of times, so I'm not judging here at all. It's how we are. It's why I think being in a community makes a lot of sense. So let's get back on task. I mean, inflation. right? We had massively high inflation last year, peaked at 9.1% year over year. I think it was last June, I believe. Yeah. And now that this is actually gone lower since this came out. And we just saw year over year inflation, everybody, come in at 4.9, a four handle. It's coming back sooner. We talked a lot at the Carson Investment Research Team why we thought inflation could come back sooner than most people expected. As supply chains get better, as rents make up like 41% of CPI. We've seen private data on the rent side, think like Zillow and Apartment List, really showing prices coming back for whatever reason. Our wonderful government takes like 6 months for their data to show up in there. So we saw reasons to think inflation is going to come back. That's a positive thing. Inflation coming back is normally a tailwind. And why does that matter? We'll talk about the Fed in a minute, but that means the Fed probably can stop hiking rates.
Well,
the Fed hiked rates
Ryan,
a whole bunch. Go ahead.
If you remember correctly, or correct me if I'm wrong, rather.
Yeah.
In 2020, when you looked at the Federal Reserve economic data that was coming in, they were actually plotting that by 2024, inflation would likely normalize based on people voting basically with bond markets. And it looks like a lot of that is slowly, if not actually, honestly, quickly coming to fruition.
Exactly. We saw about 2% inflation, for like the decade from 2010 to 2020, then the pandemic. We wouldn't be shocked. We'd be surprised if we get back to 2%. I think we can get to about 3%. There maybe are some structural things that took place, but 3% is okay. There's not 3% inflation is still really low historically. We think we can get there and then kind of go. I would be a little surprised if we get all the way back to 2%, but nonetheless, it's better than the 9.1 that we had. Now, here's a stat for you guys. Year over year inflation peaked at 9.1 back in June last year. It's a 4.9 now. That's 10 months in a row. Inflation has gone down. That's great compared to where we were this time a year ago. I looked in history. Our friends at the Fed have this data on inflation. The only other times in history we've had 10 months in a row with inflation going lower, ending in 1921 and ending in 2012. Now, think about that. That was right before the roaring 20s, a really good time for the economy and a really good time for the stock market. Yes, we had a bubble in the late 20s and the Great Depression. We'll worry about that if we get there. We don't see that scenario. But 2012, another time, not the worst time to be looking at stocks, for like 8 years, okay? So the small sample size, yes, but inflation coming back like this is more of a positive thing. These are some of the things I just kind of talked about why we see inflation coming back lower. We won't get too into it. The one on the right's the one I really think is important, though. Rents, which make up a big part of inflation on the private areas, your Apartment List, your Zillows, were telling us for a while that inflation is likely going to come back. And again, there's lots of different measures of supply chain. New York Fed does a lot of good work on this. Supply chain backlogs are like non-existent. They're like not there anymore. Okay. I mean, we all remember those pictures of the ships and everything. I talked about it earlier, but there are some real positive things. China, this time a year ago, China was locked down, shut down, open up, lockdown, shut down. All those chips, those semiconductors and things that we need from that part of the world that goes into cars here. That was why we couldn't make cars for a while. I just told you a 9% jump in number of cars produced last month that get to the assembly line. That's a big sign that China's opening up, chips are coming back, and these things are coming back. I mean, the whole transitory word, you might remember that word. That's what the Fed was saying. Listen, inflation's up a lot, but it's going to come back real soon. They scrapped that November of, I guess, would have been 21. They said, maybe it's not so transitory. But again, my question is, well, maybe it's still somewhat transitory, just going to take a little bit longer to kind of work things out because of the things that happened last year with the war, with China lockdowns. We didn't really see those things coming. They call it a black swan for a reason. You don't see it coming. But the bottom line, everybody, is inflation trends are really improving. So the Fed a little bit here. The Fed's actually hiked 10 times now, from 0% to 5.25. One thing that just happened. So 5.25 is where the Fed's fund rate is right now. Would keep this fairly simple. Inflation's at 4.9. So the inflation's lower than the Fed's funds rate. What does that mean? That means the Fed can take their foot off the pedal. The last 8 cycles, we needed that to be in play before the Fed stopped hiking. Back October, December last year, we saw, a big difference. Inflation way up here, Fed's funds rate way down there. We knew they had to get together before the Fed could maybe stop hiking, and we finally did. Now we are there. So another sign that we think the Fed could be done hiking. One other thing on the Fed, everybody, you go to carsongroup.com and click on Insights. I've got a blog on there. I do a lot. We've talked a lot about this lately. The idea, if the Fed is done hiking, which we think they are, we think the Fed is done hiking when you look at inflation and the economy is still fairly strong, so they don't need to hike like they were. The last 10 times there was the last hike in an interest rate cycle. This is going back decades. 1 year later, after that last hike, everyone, the S&P 500 was up 8 times. 14% on average. So if all you hear on TV is the Fed is done hiking and that's bearish, I don't buy it. I just talked about this yesterday with Charles Payne on Fox Business. It's not true, okay? Yes, 1981 is in there. Yes, 2000's in there. Those weren't the best times to own stocks for a year or two. We know that. It's not perfect, but a lot of other times when the Fed stopped hiking, stocks did fairly well, and we think that's really going to be the case once again.
Yeah.
Go ahead. You want to say something there? Or
No, I was just going to say, I think that, to your point about interest rates and inflation returning back to 2% or 3%, I think that we as people tend to have a pretty heavy recency bias, how it is now or how it is recently is how it's always been. But, it's no secret that interest rates, if you went to buy a home in the 80s, you were in the double digits. The 90s is when it slowly trickled into the singles. And then you saw as interest rates eased, I think people get a little caught up in the now, right? And that doesn't mean that they won't go back down there. Who knows? But those indicators are all strong in suggesting that we're at least on our way back. Yeah.
No, great points there. You think about this year so far, and what are some of the headlines? Well, regional banks, right? Silicon Valley Bank, First Republic Bank. If all I told everyone on this call was in the last 2 months, 3 of the 4 largest bank failures in our country's history would have taken place, do you think the S&P 500 would be breaking out to virtually new highs? The NASDAQ 100 breaking out to virtually new highs, multi-month highs? I don't think I would have thought that, but it's where we are. Okay, it's what's happening, and I don't want to get too in the weeds in this stuff, but what happened with Silicon Valley Bank and some of these other smaller regional banks, they made some poor decisions. Okay, bonds did poorly last year. I talked about that. They made some bets on bonds, and the bonds that they thought were sure money didn't work. Also, at Silicon Valley Bank, they didn't even have a risk officer. You're supposed to have someone in charge of
everyone left prior to everything.
Well, yeah, that's true. They got out of there, but they didn't have a risk officer for like the last 3 or 4 months before everything hit the fan. And it is what it is. I mean, we have more company specific issues that took place with some of these regionals that made some poor decisions. And then look what happened. Well, JP Morgan, some of the big strong banks kind of purchased, the smaller ones that literally just vanished off the face of the earth, literally overnight. And it wasn't fun. It's been very scary what's happened to a lot of these regional banks. You mentioned Michael Burry, by the way. I just saw his 13F, all that, no, that's stuff he's buying. Yeah. He actually was buying some regional banks last month or so. That's what you get it a month late. But again, he actually is dipping his toe in some of these regional banks. And we actually look at financials in general. We like the group of financials. We've been sticking with the larger banks though, because the smaller ones a little more volatility. But again, if you think the economy can hold in there, this earnings season, I'll talk about earnings season in a minute, but earnings season has been strong. This is more company specific, some bad apples that unfortunately made some decisions. And by the way, it's the first time ever, at least that I know of, we had a major company go under because of a WhatsApp. The WhatsApp thing on your phone. All these smart Silicon Valley guys were all on the same, guys and gals were all on the same thing whenever this took place, middle of March, saying, this is bad, get your money out.
If that's not a perfect descriptor of the efficient markets hypothesis in 2023, I don't know what is.
Yeah, I mean, and within minutes, they're taking all their money out, pushing. But remember, in the past, you had to give blood at your bank to get your money out. Now, you push a few buttons. So, I don't know if it's good or bad. I mean, there's pros and cons to that. But the bottom line is that world where you can take your money out of a bank real fast, all of a sudden the bank that was supposed to make money on that money, there's no money there. They're in trouble. We're seeing that, multiple times, and there's still very well could be one or two of these regional banks. There still could be in trouble. We're not saying we're out of the woods by any means, but I think it's really honestly amazing at how well the stock market and honestly the economy's held in there the last 2 months. If you'd said 3 of the 4 largest bank failures ever would have taken place, there's another survey by New York Fed. They look at business leaders in New York. All right, this just came out. It's fascinating to me. 6 months out, they ask, what do you think will be happening in the 6 months out? The economy and these business leaders in New York. What's in New York? Oh, yeah. Banks, financials. These are the people they're asking, what do you think is going to happen in 6 months? The highest optimism since September of 2022. Yes, the current right now optimism is pretty low, but they think, we're going to get through their side. Just today, Target, again, not a recommendation of a stock. What did Target just say? They lowered second quarter guidance, but they said, you know what? The second half, though, we think things can bounce back, and we're actually leaving our target, no pun intended, or pun intended, why not, of where earnings will be for the year. They didn't lower their earnings estimates. This is a big consumer company. The stock was up earlier. I don't know where it is right now, but they were up earlier. So again, this is like we're in this rough spot now, but the stock market's a forward-looking mechanism saying it might see better times ahead on the economy. We think that can be the case. Here's a
I
little
think
joke.
my wife is a leading driver in Target success for Q2.
Yeah, we like to help Amazon around here. I trip over a box every time I walk in my house at Amazon. Anyway, Giannis, this is like a little joke, but when he first, famous basketball player for the Milwaukee Bucks, in case you don't know, he when he first came here, he heard about FDIC. Your money's only good for $250,000. This guy's got a little bit more than $250,000, being one of the best players in the world. He put his money in 50 different banks. Now, it's kind of funny when you hear it until you take a step back. He grew up in Greece. He saw his family's money wiped out. He saw his, everyone he knew, they all lost their money on bank runs in Greece in 2010, 2011, 2012. So if that's how you grow up, if that's how you see the world, I half made a joke, but maybe he was smarter than everybody else because this whole money's insured up to 250. That's what, by the way, that's what scared a lot of people with Silicon Valley Bank, because a ton of money in Silicon Valley Bank was well above 250. So that's not sticky money. They were like, oh, this goes under, I'm only insured up to here. I'm going to get my money out. So I've got my money. So Giannis kind of thought of that beforehand, but what's going on now? They said it, but didn't say it. Janet Yellen's in charge of Treasury. She hasn't backstopped everything, but they have hinted time and time again that your money, if you got a couple $1 million in a bank, I can't say this, officially, off officially, but the Fed has hinted that your money's pretty much backstopped, right? They've said that without saying it. And I think what's going to happen here, Jake, is we're at 250 FDIC. Last time it was increased was 2008. Just look at inflation. What 250 is worth now versus, I don't even know the exact number, $350,000, $400,000.
Right.
Just for inflation, I think they need to update the FDIC. And Washington is divided. We get it. But one of the few places I think the left and right agree is maybe we should up that FDIC to say $500,000, maybe even $1 million. I don't have the number. I don't know. But just to bring some more confidence back could really help. What's your take on the FDIC stuff? Do you get those questions with your clients?
I definitely do. I think that Giannis is a funny example, especially because we were just talking about it in my office recently. I mean, his guarantee contracts could pay for a city in Greece when the banking pricing happened, right? So the FDIC thing, I think that we really saw the FDIC and the government step up with Silicon Valley Bank. There's a few things that I think are really important there. And the first is that the most blaring example, I think, was Roku. I don't know if you remember reading that. I think we talked about this maybe a month ago. You and I, but they had $57 million in a singular checking account. That was their operating account. There was no other accounts being distributed there, which frankly, I'm actually surprised that Roku has $57 million. But secondarily, I think this is a beautiful example of how when we see singular events on the news that look to be gloom and doom. Now, of course, to your point, Black Swan, right? COVID, Spanish flu, whatever you want to use as an example there. It's so difficult to use a singular event, or in this case, 4 banks closing, as an indicator of consumer confidence, as an indicator of the U.S. economy. I mean, there are billions of variables that go into this. It's the same with presidents and Congress and Senate, you name it. But I think there's a great lesson here.
Yeah, I mean, like First Republic, right? Second largest bank failure ever. They were around on Friday. By Monday, they were out of business, and JP Morgan owned them. And if you had money with them, honest to goodness, nothing really changed. Yeah, the name changed on the top. I'm not minimizing that, but it's not good what's happened. Don't get me wrong here, because what's happened, a lot of these bank stocks have gone down a lot, right? And these regional banks are smaller companies, so small caps in general have really gotten hit. Large caps has done just fine, honestly, in the whole scheme of things. But we do like small caps, like I talked about. So we think, we get some low here in regional banks, some more confidence come in. That's another reason to think that there can be some opportunity. I look at the clock. I mean, you and I could talk all day. I probably need to move a little faster, or hopefully everybody's liking this. We can just keep going. We might talk another 15 minutes, leave 10 for Q&A, and that's an hour. Hopefully that works for everybody. This is fascinating stuff. Congress, by the way, there's a little joke. A friend of mine, Sam Stovall, maybe you've seen Sam on TV before. He says this. He says, the opposite of pro is con. The opposite of progress is Congress. That's a good one. Hey, that's a little joke there. Thank you, Sam, for that joke. So We have a split Congress. We knew that coming into the year. Now, not by a lot, right? I mean, Democrats barely have the majority in the Senate. Republicans are like the smallest House majority in the House in a long, long time. So we're about as gridlocked as you can get. Funny thing about Congress and about Washington, stocks like that. Maybe the best Washington is one that can't get something done. This is plain and simple. What I'm showing you here is how stocks do under a divided Congress. Last time I had a big down year was 1981. All right. That was like a recession year. So most other times you've had some pretty decent sized gains. And so far this year, we're off to a good start. So just because we have a divided Congress, you shouldn't worry. Now, believe me, I don't even think I got the slides on this. We'll talk briefly about the debt ceiling. So we do have a divided Congress. You know, last time we had a divided Congress and a Democratic president with a major issue with the debt ceiling was 2011. Anybody remember that time period? August 2011. U.S. debt downgrade, S&P 500, no, sorry, S&P downgraded U.S. debt because of the coming potential crisis that they saw with the debt ceiling not getting done. Stock market sold off like 19% in 4 days, the S&P did. Big issues. Now we bounced back and came back, but still, well, what's worrying people is we're going to get to the brink again and then go off. We don't think we're going to have a default. I mean, listen, it's an election year next year. Washington's going to jarbone and do their thing back and forth, and everyone's going to claim victory. We think it'll be an 11th hour. Okay, now here's some stats for you. I thought this was interesting. The U.S. first time they had a debt ceiling was in 1917 to help finance World War I. And they've increased the debt ceiling more than 100 times since then. Every president since Eisenhower in 1959 has increased the debt ceiling at least 3 times. President Biden's done it twice. Okay, we think the 90th time since 1959 is coming, and it's just kind of where it is. Now, we could be wrong. You know, maybe Washington goes off, and what does that mean? Listen, we probably go into a recession. If we truly went off the ledge with the debt ceiling, didn't get a deal, interest rates would soar. Lots of bad stuff could happen. That's not our base case. I'm going to be very, very clear there. You know, maybe 1 or 2% chance, always a chance, but we just think cooler heads are going to prevail. Stock market's popping today, okay? We're getting a good pop today. They're saying that we're getting close to the structure that might come out this weekend. We'll see. And it's something called X date. All you got to know, I don't want to get too geeky with this stuff. X date's like when we can't pay our bills, right? $31.4 trillion is the debt ceiling. Once we run out of that money, we run out of that money, right? Veterans won't get paid, Medicare, Social Security, a lot of these things aren't going to get paid. Nobody really wants that, especially coming into an election year, left or right. So we think the deal is going to get done. Hopefully have a little more progress versus Congress regarding that. I mean, let's keep this one simple. Inflation's been high, yes, but income growth is still strong. People are still making money. The employment, we created, we being the U.S., 5 million jobs last year. We've made another 1 million jobs this year. It's hard for us to see a recession when you're creating jobs like that. Yes, manufacturing had a recession. Yes, housing did. But the consumer makes up 2/3 of the economy. When we look at wages are coming back a little bit. If you don't want massively high wages, that means it's inflationary, but we're still seeing strong wage growth as it pertains relative to inflation. And a lot of people are still getting jobs. I mean, believe me, things have slowed and we get it. The headlines, you know, some of the major layoffs, you know, Meta, that's Facebook, and Google and Apple, they're laying off companies. So these are people that are companies also like doubled the size of their employees the last 3 or 4 years. There's a lot of other companies that are actually hiring out there. The media's got a job to get you to click on it, right? Not saying the media is good or bad. I've made a career working with the media as well, but I'm just saying to be aware that they're not telling you, you know, Meta's laying off. Well, Ford's actually hiring over here, especially in this part of the country.
Right? Hospitality hired more.
Exactly. Hospitality's going crazy. Airlines. I mean, every time I fly, my God, the airlines are booked. I mean, every steakhouse. I know I go to a lot of steakhouses, get to go on the road and you go to the steakhouse. It doesn't matter what night you're at the steakhouse. It's packed. Okay. So again, things aren't perfect, but the economy is still strong with the, we'll just kind of skip that one. The idea of debt. I mean, I'm sure you've heard this one, Jake. You know, the economy is growing just because consumers are maxing out their credit card. Right. We got data from our friends at the Fed just this week, I think on Monday, over $1 trillion of credit card debt, all-time high. It is 100% factual, all-time high in credit card debt. What they don't tell you, and I call this denominator blindness, it was like $1 trillion back in 2008. Take a wild guess what net wealth is. Net wealth is up substantially since 2008. So denominator blindness, yeah, there's more debt, but there's a ton more equity. What we're showing here is it's called credit utilization. Keep it simple. $10,000 credit limit on a credit card, you spend about $2,200. That's where we are right now, about 21%. That was running much higher pre-pandemic. So again, yeah, some people might be stressed with what's going on and using their credit cards. We're simply not seeing, though, people maxing out their credit cards. We think consumers are actually in fairly good shape. I mean, that's what Target just said today. The consumer's still in pretty good shape. What Target just said. So corporations, all right. I just the one I'm working at right here, Carson Group, right? We're in good shape. We got a little leaner, a little slower. We didn't hire as much the first, we'll say 4 or 5 months of this year. You know, just like a lot of people looking around, making sure things are good. Companies are anticipating a recession. Okay, so they're getting in place before. I can't tell you a time that's ever been a well-known, hey guys, the recession starts in June. Like, nobody knows that, but companies are positioning for it. So in a way, they're pulling back, and I'm not calling it a self-fulfilling prophecy. I don't think it's that case at all, but companies are getting ready for it. I think if we don't have one, which we don't think we're going to, second half of this year, we think we're going to have some animal spirits and some better times coming. Then companies get out there and start hiring and growing again, and we had a little slowdown. We're going to have negative earnings growth 2 quarters in a row. This quarter was down like 2%. We were down fourth quarter last year. That's an earnings recession. Now you hear that and you go, oh, that's not good. We also just had a manufacturing recession. Ooh, that's not good either. In 2015-16, we had a similar situation where manufacturing and earnings were in a recession. Economy slowed down. No question, economy slowed down. But it didn't go into recession and then continue to go higher. We think, or improve. We think that could be a similar case where we're at now. This is a bunch of pretty colors. It's just globally looking at manufacturing. The bottom line, we had a lot of red. We're seeing some different colors. This is the easiest way to put this. We are seeing manufacturing come in stronger. Just yesterday's industrial production numbers, which are real numbers that people look at, not some poll, not some opinion. The hard data continues to suggest manufacturing has bottomed, not just in the U.S., but globally. Now that China's reopened and going, you know, stocks like Ferrari at all-time high. You think you're going to have a global recession when a stock like Ferrari's an all-time high? I'm just going to say I don't think so. So those are some positive. I think I got only a couple more, then we'll be done. You hinted at this, Jake, just the idea of kind of things bottom. Actually, you said the recession. Like, we know the stock market bottoms, and then you finally, oh, we were in a recession. You find out.
I mean, I think you had the great quote in Vegas when I saw you in September that, you know, economists exist to make meteorologists look good, right?
Yeah.
And usually a rear view situation.
Yeah, that's a good one. Yeah, I like that is a good one. Yeah. The joke about economists. I play an economist on TV once in a while, but nonetheless, this is just a cool chart from our friends at JP Morgan, and it's just plain and simple. The S&P 500 is that dotted line. Just look at these different cycles, right? Stocks bottom before what all we have in there: earnings, payrolls, and GDP. Stocks, and that, now honestly, guys, on the other side, they peak before also. But right now, we think we're in a similar situation where stocks bottomed in October. Last October, that was like the low, 25% bear market. It was a midterm year. You tend to have bear markets in midterm years. You can have weakness. The October low, 6 of the last 17 bear markets ended in October. We think this one just did as well. So that's 7 out of 18 now. But now stocks have gone higher. And people are like looking around like, well, the housing data has been bad and this has been bad. We think stocks are sniffing out once again a turn in the economy. One thing about earnings, S&P 500 earnings for 2013 was going down for a while. It just bottomed and started to trickle higher again. That's kind of like a cruise ship. That takes a while for that to happen. So there's some positive things on the earnings front, the housing front. Payrolls have still been strong. So it's not, you know, your typical slowdown recession, but to see stocks bouncing off the lows before the news gets good is not rare at all. And we think it's happening again. Just kind of a big picture thing. It's never too late. I thought this is fascinating. Check out these names when they started their companies. All right. I mean, that's Colonel Sanders. I grew up in Ohio. Okay. And we ate a lot of KFC. He was 65 years old when he came up with the secret 7 ingredient recipe for KFC. Anyway, so just kind of fascinating. You know, when you think about some of those things. Couple more. This is a simple way to look at it, but I like to keep it simple sometimes. When inflation's lower from the year before, like we expected to be this year, and that's playing out, what happens? Well, stocks are up 12.5%. You can see on the left. When inflation's up, stocks are about half that. Your average year, ballpark 9-10%. So again, we knew this coming into the year, that if inflation comes back like we thought it would, and it's even come back faster than honestly we thought it was going to, those are positive things historically. Always can be something different. Yes, when you stack all this together, it can be a positive thing. This is a wild one, Jake. When the first quarter gains at least 7%, remember I talked about the 5% gain like on that first or second slide. Right. When the first quarter gains 7%, check out what the full year does. Never been lower. This isn't a guarantee. Just
I've
point it
also
out.
never seen that many greens on an economist screen before.
Exactly. I mean, look at that. I mean, that's, again, we'll see. Now, that doesn't mean the rest of the year is going to be higher. You can see 87 in there. Stocks actually were up 20% in the first quarter, down 2. But most of those years, those numbers on the right are still higher than the ones on the left. But never have we seen a year down for the year. Now, that makes sense, right? If you're up a ton by November, you're probably going to be up for the year. But this is a different way to look at it, the first quarter. But a good first quarter tends to usually mean you're going to see some green by end of the year. And we're clearly in that camp. We did just see 5% back-to-back quarterly gains, actually 7% 2 quarters in a row. And this is a simple way to look at it. Look at those green dots. It tends to happen during periods of strength. This is not, in our opinion, a bear market rally. People call it a bear market rally, meaning stocks are up, they're just going to roll back over, right back to new lows, the October lows. We don't see that at all. That's how we're positioning and talking about things. You tend to see 2 quarters in a row of big gains, kind of at the start of new bullish phases. So just kind of be aware of that one. Let me skip that one. This is a good one. I'll read it. It's another, it's never that simple. I hope I am making it simple to understand. Believe me, it's never that simple. But if you look at all the information, hopefully we're laying out a path that, listen, things aren't as bad as they're telling you on TV. And we really think stocks are going to do pretty well for you. Even bonds. Bonds are going to do okay for you, but stocks still do a little better. Here it is. On Wall Street today, news of lower interest rates sent the stock market up. But then the expectation that these rates would be inflationary sent the stock market down. Until the realization of lower rates might stimulate the sluggish economy, push the market up before it ultimately went down in fears that an overheated economy would lead to a reimposition of higher interest rates. That was from the early 80s. Okay. That is, oh, hey, Mary. That's right. But that that's the early 80s. That's kind of like today. Honest to goodness gracious. Like on Monday, market was bouncing. Yesterday it sold. Everybody's trying to figure out why. And you talk to it and you watch CNBC in the morning. They say it's one reason, but later in the day it's another. It's never that simple. We like to say, follow the facts, follow what we know. We know earnings are starting to improve. We know manufacturing is getting better. Stocks are actually cheap. I know that might sound weird. Well, maybe not that weird. Stocks have gone down a lot, but earnings have gone up. Their earnings are starting to improve a little bit. So, I mean, stocks are cheaper than they were this time 15 months ago, which if you like buying things that are cheaper, there's some good opportunities there.
I think P&Es are good to look at. And I think that, to add to your point, the main difference there is that in the 80s, they didn't have Jim Cramer on TV breaking mugs with baseball bats to get attention, right? I mean, there's an old, I don't know if you've ever heard this, and I'll make it really quick. The producers of the Jim Cramer show had a previously successful show that they wanted to take and put a financial news spin on it. Now, my clients have probably heard this, but Ryan, I don't know, have you heard this one before?
No, go ahead.
Any guesses as to what that show was?
It was a Jim Cramer show?
Jerry Springer.
Oh, wow. Okay.
So in the world of financial news,
wow,
I like to lean on data, not the news sources.
Hey, he was the mayor in the city I'm sitting in right now. He was the mayor of Cincinnati. I mean, I got in trouble. Well, the lady of the night, and the rest was history. But you can go Google that one. But yeah, nonetheless, I always, the Springer show always reminds me of being homesick. When you're homesick, and the Springer show is like the one thing on. Anyway, we can go. Don't need to talk about that too much more. But yeah, that's interesting. But that's the other thing about the media. I mean, again, there's a lot of good information out there, a lot of smart people, but their job is to get you to watch what they're doing. Okay. So they're going to talk about the negative stuff because our brains are wired. We remember the negative stuff like 8 times more than we remember negative stuff. I can tell you kind of one finger, all the games I've coached my kids, the ones that stand out to me, and maybe you guys this way too, are those close losses in championship games. Not the time my son scored the winning basket and stuff. I remember those too. It's just the way our brains are. It's the way it is. We remember the bad stuff more than the good stuff. And the media knows that. So they're going to point out the bad stuff first to get your attention, to get you to click on it. What's the old saying? The world is going to end at midnight. Tune in tomorrow to see if it happens, right? That's what the media is trying to tell you every single time. And anyway, that's that. So just, I'm not going to rip on them too much, but just be aware they're not always on your side.
I won't show this to them. Don't worry. I will.
Yeah, it's all right. It's all right. So this is just some really cool stuff, I think. It's the 3rd year of a presidential cycle. It is what it is. This is just something to know. Stocks usually do pretty well. Why in the world is that? Well, an election's next year. This isn't about left. This isn't about right. It's not about blue. It's not about red. It's about getting the economy going to get people in a good mood, likely meaning your stocks are worth more. So there's an election and you can potentially win the election again, right? The government can pull certain levers and do certain things. And you see it here, year 3, up 89% of the time, 17% on average. When the year before was negative, like it was this last year, up 25% of the time, up 25% on average. Higher every time. It's not a very big sample size, but nonetheless, we knew this coming into the year that suggested, stocks might do okay this year. And we think that's really where we're going to be. Kind of skip that one, sort of the same thing. That's a little more confusing, so we'll just I know we're at the end. I mean, bottom line, this is some of the big picture things I've talked about. We still like stocks to do fairly well here. We think bonds have an opportunity also. We don't think bonds will do as well. We think bonds can gain by the time the year is over, maybe 4 to 5%. Stocks, like I said, maybe 12 to 15%. Maybe small caps can even do better. And I know they're a long way from now, but we think small caps really could have an explosive second half of the year as a realization this economy led by a strong consumer with housing coming back that nobody's talking about, with manufacturing coming back that no one's talking about, can be some real positive things out there that for your investments second half of this year can be a pretty darn good one. Final thing is Seward's folly. I'm going to paraphrase it. Hopefully I don't mix it up too much, but Seward was the gentleman behind buying Alaska from our friends in Russia, but from Russia. And
previously friends in Russia.
Yeah, previous friends. And at the time, it was considered this big, just waste of money, this big, iceberg. There's nothing there. Why do we do it? It was called Seward's folly. People hated this idea that we bought this nothing land. Well, you know what? Every 6 days, we pump enough oil to make enough money to pay for what we paid for this. Now it's back in like 1850, but nonetheless, so I guess my key concept is don't always judge a book by its cover, right? The stock market, it might look bad now. That doesn't mean it's going to look bad next year. The economy might not look great now. That doesn't mean it's going to look terrible this time 6 months from now to a year from now. And I think it was Seward's folly. It was anything but a folly. It's really helped our country grow substantially with what we paid for it to how much money we've made of those natural resources that were in the ground that honestly Seward probably didn't know all that oil was there. But hey, it is what it is. Sometimes being lucky, nothing wrong being lucky either. And that's just one way to look at it. I think got some disclosures. Yeah, disclosures. Just got to show that. And there we go. Thank you for joining. All right. So how'd we do, Jake? I mean, I went a little longer. I got 10 minutes for Q&A. Hopefully, maybe we answered every question. And that was a lot of fun. Again, I just want to point out, I get to do these a lot, and I'm honored to have been here. And again, everyone on this call, just the fact that Jake does these, reached out to me, and can leverage the research team at Carson and all the other resources that Carson Group has. Hopefully it makes, his life easier to help service you guys, because it's not easy what's happening out there. No one has all the answers, but I think, we're all on the same side of the table. We're here to help and try to help you reach those long-term investment goals. And, just like I said, have a plan in place. It's important. And all of you do working with Jake. And I'm just so honored to be a small part of it.
Well, I very much appreciate the kind words and really appreciate you being here and doing this. And I'm sure we'll do more in the future. Yeah. I think people could listen to us talk all day. Well, I think we could listen to us talk all day. They don't probably want to listen to us talk.
Yeah, I do have a podcast, Facts versus Feelings. Maybe a shameless plug. If you like the stuff I talked about, I do one with Sonu Varghese on our team.
It's like Joe Rogan. Joe Rogan.
Yeah, we have fun with it. We have fun with it. Sometimes this stuff gets boring. I like to have fun. This stuff sometimes talking about the Fed all day, it's kind of boring if you ask me. But I mean, I do it for a living. But there are some other things to point out. So yeah.
Well, I mean, I think we have a couple minutes left. Are there any questions? Anyone want to chime in or perhaps write something in the chat? Like I said,
and I can just kind of answer. Go ahead and do that, guys. I can answer some of the questions that I know I tend to get that maybe I don't even ask or talk about because I know they come. The idea of gold. A lot of people talk about gold. I mean, do you have a strong feeling on gold, Jake, when it comes to your clients? Or I mean, that question comes up a lot. That's the reason I'm asking it.
I think that whenever gold is brought up, I typically think of this notion that, what are we going to do with it? Are we going to walk into our closet and chip off a nugget and go to the market and barter? Because at that point, if that's where we are as an economy, there's a lot of other things I'd rather own that are not gold. And if you look at it from a returns perspective, I don't always feel it's a strong place I really don't feel it's a strong place to be long term.
Yeah, no, I can't totally disagree. We added a little bit in some of our more tactical models, just if there was more trouble with the debt ceiling and things, we think stocks will still do better, but gold's a popular question that we get. So maybe, with bonds, maybe given a lot of the gains so far, there could be a small sliver for a portfolio is how we see it, but gold's a popular question. Also debt, believe me, I mean, the debt, I'm not crazy about 31.4 trillion. We're going to up it again, spending all this money. I get it. All right. I get that question all the time. Here's the truth though. We do have the world's reserve currency. March of 2020, gold was killed, stocks were killed, even bonds were killed the first 3 weeks of March of 2020. Go back and look it up. You know what wasn't killed? The US dollar. The cleanest shirt in the dirty laundry. Reminder to us and the rest of the world that we do have the world's reserve currency. And when you have the world's reserve currency, can you play by a different set of rules? Can you have all this debt and it's not going to impact you as much? I mean, again, I'm not crazy about all the debt. I want to be very clear.
Sure.
But the answer is I think it can't, right? And we still have that world's reserve currency. As long as anyone's alive on this call, I think we're still going to have the world's reserve currency. So I want the spending to get under control just as much as everyone else does with Washington, and make smart spending decisions. But at the same time, we do have the world's reserve currency. So that's something to remember. And just that idea of denominator blindness. Yes, we've got a ton of debt. All right, a ton of debt. But equity has increased, and in a lot of cases, even more than that debt. So again, the $1 trillion in credit card debt, that's where we were in 2008. I don't know the exact net wealth number, but I think people are worth literally double what they were from 2008 right now. So credit card debt's the same, but you're worth twice as much.
With healthier equity.
Yeah, much healthier equity. That's not the title you saw 2 days ago when MarketWatch had his headline, credit card debt, all-time high. They don't tell you that overall net wealth, and as terrible as last year was, your stocks were down 15, 20%, just ballpark numbers. Your bonds were down maybe double digits for the first time like ever since George Washington. But how'd your house do if you owned a house? You made some equity in your house. I know that's not as clear cut, and I'm not minimizing what happened when you got your 401k statement or your statements in the mail or statements online, because you probably lost last year. We all did. But houses did okay. So there's different ways to look at overall net wealth, and that's important. And then the idea of the debt ceiling, heard a ton about that. We talked about that already. And the idea of regional banks, think it's a few bad apples. Yes, it's rocky, but fascinating that we've been able to withstand just historic 3 out of the 4 largest bank failures ever. And we've been able to withstand it, and stocks are doing fairly well. We think there's really some opportunity, although we are personally sticking more with the large financials, which got hurt too. I mean, they got hurt as well, but some of the large financials are in really good shape. And those are some areas we think provide some decent opportunity. If you don't see a recession coming, things like financials and small caps that got beat up a little bit, they might be some good areas to look for some potential appreciation here.
When I think all this being said, and we'll wrap up here in a minute, I'll give another minute if anyone wants to type in a question. Everything you just said is a bit of a summary of how oversimplified people tend to make the complex. Now, our job is to explain it in a simple manner, but nothing about what we're talking about is simple. In the same way that there is a place for gold to complement something in a portfolio, it's never as simple as I'm always in gold. In the same way that Sam Bankman-Fried was this genius in crypto that everyone put every penny in, there's a lot of good lessons here about not putting all your eggs in one basket, the old adage of diversification, but also not putting all of your emotional or cognitive weight in the opinions of everything going on with markets, right? We don't know. We just don't. And I think that this is another really good example of that.
Yeah, no, love it. I can't disagree with anything you said there. I mean, that's all true. And there's lots of smart people out there, and sometimes they're right, sometimes they're wrong. I think, what I have found in my career doing this for multiple decades, working with advisors and clients for the last 6 or 7 years, some of the best investors are the ones that set it and forget it. And what I mean by that is every 2 weeks, your 401k, or every month you're doing investment, you just you do it, right? And over a decade or two, and I know there's always different time frames. Someone on here might be closer to retirement, so I'm not talking necessarily to you, but if you've got a couple of decades to retirement, you honestly want a bear market. Nobody really wants a bear market, but you can buy things at a lower price. And every 20 years, the S&P 500 has been up. Okay, you can buy any period in time and hold for 20 years, you make money. Now, sometimes it takes 20 years to make money. I want to be clear. But if you use these opportunities and follow your plan and don't panic, that moment you want to call Jake and say, I can't take it, get me out of this and let me go into gold or let me go into cash, or the opposite is say, you know what? This Bitcoin thing, look how great this is, sell all my blue chips and get me in that shiny object up there. It's that time, the way our brains work, that we want to make the worst possible decision and just be aware of that. And it's not easy, believe me. I know that, but that's why working with Jake before you make any major decisions is going to be in your best advice.
There's not much I can do after the decision's made. But one last quote, and then there's a question here, and it was one that you may have said as well.
Yeah.
It's the last quote, I promise, because I think we could write a book. A portfolio is like a bar of soap. The more you touch it, the less you have, right? So there's something to be said about the old long haul. But anyway, you want to jump to the question here in the chat? And then
just the idea. So we've been hearing a lot about the US dollar losing its reserve currency status that I just talked about. China's trying to do some things, other parts of the world, mainly China, to get the yuan to replace the US dollar. It says it's too soon to worry about most of Central America choosing the Chinese yuan over US dollar. We'd say yes. We haven't had a crisis yet. I hate to say, let's wait till the crisis happens, right? I mean, that's not when you want to panic. The time to panic is not in the middle of the eye of the storm. It was before the storm came. You got to get ready for it, right? But when the what hits the fan, we still feel quite confident that the dollar is where the safety is going to come and flock. I mean, they're one of the big, you say, what are the big worries that are out there? Listen, U.S.-China relations are about as bad as they've ever been, right? The whole Taiwan thing, and I'm no expert at all in any of this stuff. You guys probably know more about it than I do. But Taiwan, and could China do something there? Those are the things that could really upset the apple cart. I have no idea if they're going to happen or not, but U.S.-China relations, and you start seeing the things China's doing. Of course, they want to have the world's reserve currency. Why wouldn't you not want to? I can't blame them for trying, but we just still think the U.S. is that area. I mean, China, what have we seen throughout history? Communism just doesn't really work. All right. We've seen that, right? Their stock market hasn't done that well. Now their economy's coming back a little bit. So I think, I'd stick with capitalism. I'd stick with the way we have things in the US. And I feel pretty comfortable saying the US still has the world's reserve currency. And we'll know next time we have a major problem, major calamity, if the dollar gets a strong bid just means people buy it. And if it doesn't, then that'd be different. But what we've seen is clearly just last year during the slowdown and the recession and or potential recession last year, dollar was really strong from January to October, huge rally in the dollar. Now it's kind of rolled over. So that was a time things weren't very great. So we'll just see. But great question, and one we've heard a lot about. But we still think the U.S. has a world's reserve currency, and that's not changing anytime soon.
I don't think so either. And I think there's a longer conversation to be had there about, China buying mineral rights and a number of other things there that could really add some complexities to the conversation. But I very much agree. But anyway, we are on 2 minutes past the hour. If there are no more questions, or perhaps if you have any, don't hesitate to reach out. Thank you everyone for coming. Ryan, this was great. I really appreciate it.
Sure.
I will do more in the future. Perhaps we will fly you out when it's not August like you were last time, when it's not 118.
Melting. Yeah. Although I like the in and out, that's good stuff. I mean, I work for food, so maybe I come out there for an animal style burger, but yeah, maybe not 118 degrees.
I can FedEx you one if you want. Just depending
Really?
on the time of day.
I'll just come out and get one. I think it'd be better.
Fair enough. All right, my friend. Well, thank you again. It was
Yeah.
great talking to you, and thanks for sharing everything. You're always a great resource for everyone. So you guys can also find Ryan, like you said, on podcasts. You'll frequently see him on the news. I mean, you just with Fox Business yesterday.
I was Fox Business with Charles Payne. I do a lot with Twitter at Ryan Detrick. If you use Twitter at all, social media, LinkedIn. I mean, there's the different places. I'm out there. So always trying to share, again, put my unique spin on what everyone else is talking about. It's what I try to do.
Like we do our best to share. Yeah, we do our best to share everything you and your partner Sonu send our way through blogs, resources, white papers. So if anyone has any issues finding those, just give us a holler and we'll connect you to those resources. But otherwise, thank you again, my friend. I'll talk to you very soon. And thank you all for coming, and have a great day.
Go get lunch, everybody. It's lunchtime for you guys. We'll see you.
It is.
Take care. All right.
We'll see you soon. All right.
Bye-bye.
Thank you.